evolving landscape in international taxation. I welcome you all and thank you for joining in. For today's webinar, we have two speakers with us today. Our first speaker is Nupur Jalan, who is an international tax professional, and our second speaker is Professor Alexander. He's a professor of taxation and commercial law at Hamad bin Khalifa University, Qatar. Nupur, she'll talk about global developments in international tax world, and Professor Alexander, he'll discuss about taxation of multinational enterprises. Yeah, I can see many people have joined in, so we can start our webinar now. It's for around 40 minutes, and we'll have Nupur, and after Nupur, Professor Alexander, he'll be speaking. You can type in your questions using the chat facility, and we will be taking the questions towards the end of the webinar. Um, Thank you, Nupur, and thank you, Professor Alexander, for joining in. Nupur, over to you now.
Thank you, Anu. So I'll start the session. So the topic given to me is too broad, so I can cover everything under the international tax in this topic. But I thought of not presenting a presentation rather than speaking out of the mind to just present the entire debate going around in the globe on different topics of international taxation. So starting any discussion on international tax in current world without a BEPS discussion would be incomplete. So I start with BEPS. So BEPS was started in 2015. It recommended 15 action plan aimed at bringing more transparency and cooperation coherence amongst the nation. BEPS laid down few minimum standards, like the minimum standards were Action 5, 6, and 13, which majorly dealt with harmful tax competition or the prevention of abuse provision and the transfer pricing documentation. I see many countries in GCC region also have been part of this inclusive framework. To my mind, Kuwait has not signed. Other than Kuwait, all the countries have signed to inclusive framework, and many countries in GCC have started implementing transfer pricing documentation and have been active with it also. Even I see a lot of developments in GCC region from the VAT mechanism that was implemented few years back, like say 2-3 years back, and the situation that we stand today. There has been a lot of technological progress and procedural improvement in the entire compliance process. So the idea of this BEPS was to at least that inclusive framework members start following the minimum standard. So we can expect that in coming time, even GCC region, apart from the transfer pricing documentation, which has been already accepted by many of the GCC countries, other minimum standards will also be implemented by the GCC region. Or now coming to MLI, so the action plan 15 of the BEPS dealt with MLI, which aimed at bringing in all these changes, the BEPS changes, through a multilateral agreement. In the MLI also, there are few minimum standards that are aligned to the BEPS standards. At present, as on date, 94 jurisdictions have signed for the MLI, and out of which 55 have ratified the MLI. So it is hard to say that whether MLI will bring much changes to the system of international taxation, because it entirely depends upon the jurisdiction. So I did an analysis from Indian perspective. To my mind, apart from the minimum standard of treaty abuse or the PPT rule, principal purpose test, it was not able to bring much changes in the Indian system, because for MLI implementation of any provision, both the signing countries or both the treaty partners should ratify a particular provision. So it entirely depends upon how countries have ratified and which provision of the MLI they have accepted will determine the impact of MLI on that particular jurisdiction. So in a way, MLI, I don't see much of a change except for bringing in minimum standards of treaty abuse that is to be accepted by all the jurisdiction. There are few other important provision like the permanent establishment provision and the dispute resolution, where there is a lot of arguments like whether countries should go for arbitration. Arbitration is a big issue now because some countries are not agreeing to the arbitration provision on the sake that it is impacting their sovereignty, so they don't want to accept arbitration clause for dispute resolution. This is also one of the issue with the dispute resolution of pillar 1 and pillar 2 solution, wherein countries are simply saying that they don't want to go for arbitration and they have to find out a middle way out. So now I jump onto the transparency wing. We see a lot of development from transparency wing also, transparency side also. So entire wing of OECD, the Global Forum on Transparency and Exchange of Information, is taking care to improve more and more transparency amongst jurisdiction. Like they are continuously monitoring the exchange of information standards and doing peer review to see whether jurisdiction are following or exchanging minimum information. They are providing countries assistance and technical assistance in implementation of various transparency standards. Even to say, if I have to look at transfer pricing documentation, the master file, local file, or the CBCR, this all are aiming at improving the transparency too, because many countries now, like in 2019, December 2019, Shell has made their CBCR report public. So this is a way of showing that companies are not hiding anything. They are willing to share their data. And even I hear more companies will be coming out and sharing their data publicly, the filings they have done for CBCR. This in a way is increasing the stakeholder confidence also in the company. To my that is what I believe, and we can see more of companies disclosing their or making their public CBCR report public in coming days. Now, even this CBCR data has been used for multiple purpose, like the entire impact assessment under pillar 1 and pillar 2 of the current proposal was done on the data collected through CBCR mechanism. So even a specific jurisdiction like UK, Australia are trying to use this data collected for CBCR for different purposes, and countries have signed, agreed to exchange CBCR data. Even UAE countries have agreed to exchange the data collected through CBCR. So yeah, we see a lot of development from other than this from the ICAP perspective also. So there is another proposal which is going on, or which is in the phases. OECD is still building on the tool for ICAP, wherein companies can get their risk pre-assessed before, so that it's kind of a dispute prevention tool, so they don't end up in a mess later on, and they are sure of the actions they are taking on. Other than this, there is CRS mechanism, which is which also aims at taking care of disclosure of income, disclosure of much of the information. And I see a bit of movement or sense of movement amongst the taxpayer and tax authority towards a joint audit system or a cooperative compliance mechanism, wherein they can either carry jointly audit in two jurisdictions, or can carry on assessment simultaneously for the same taxpayer. Like the tax authorities, there's a difference between joint audit and simultaneous audit. So there's a difference between joint audit and simultaneous audit. So these are mechanism of cooperative compliance, wherein both government can work together to resolve any issues that arises with the taxpayer. So from the dispute resolution side also, we see a lot of development from MAP perspective. OECD is conducting MAP peer review time again and again. Recently, we had a public consultation document for MAP, for which the comments, I guess, were accepted till January. So a lot of developments are taking place in the EU region also. In EU, we have DAC 6, DAC 7, which entail host lot of information from the taxpayer. So this all are just done to increase the transparency and get hold of more and more data from the taxpayer side. On one hand, this mechanism are good to increase the transparency, but this raises a biggest question of taxpayer right too, because there has been a lot of discussion in the recent time on the taxpayer from the taxpayer right perspective, like within the academicians and even the professionals, and we have good cases in EU region which have dealt with taxpayer rights situation, like the Berlioz case or the Sabu case. So the question arises, are this mechanism or the data collected will indirectly lead to data security issue or data privacy issues if this data, which is collected from taxpayer on the sake of transparency angle, are to misused, or in a way they are not used in a manner in which they were taken, for which they were taken. So countries have also started realizing the importance of it. We see that India has released recently, a few months back, a taxpayer charter bill wherein they lay down the rights of the taxpayer. And it is hopeful that more countries will be coming up with taxpayer charter bill in coming time. So now I will move towards the technology side to give a glimpse that how technological changes are being implemented in the tax administration side. So more and more tax administration around the world is trying to adopt the digital techniques, or are moving toward a digital transformation. This is not specific. I did an analysis of the region wise, and I don't see that it is specifically focused that I can say, okay, Asia is doing good with technology, or Europe is doing good with technology. Every region is trying to develop. The tax authorities of every region is, in a way, some bit trying to move towards the technological side and bring more of technology solution for compliance, for compliance or the audit purposes. Like we see more of e-invoicing, e-filing, e-audit, e-assessment. How, the biggest question that this all are good, of course, if the processing cycle is reduced, it is good. Like we can say that with this technological advances, if say 5 year before now, 5 year down the line, the cycle will be reduced. Now without technology, if it takes 3 years to close a file for the tax authority, with technological development and the digital transformation, the data will be easily available and the cycle will be reduced. Say the data gets processed in 3 months. But again, this too raises a big question of taxpayer right, that the taxpayer will have now less time to raise their contentions in the appeal procedure. On one hand, digital technology is doing good, but on other hand, it can raise a lot of questions from the taxpayer right perspective also. So let's see how technology brings more and more changes in this world of digital transformation. Now, I'll just touch base or brief about the most heated topic of a heated debate of today's scenario of international tax world, that is the taxation of digital economy. So digital or data, I would say, not only digital. So what we see is that most of the tech companies are not being taxed are not paying their fair share of taxes. And what is happening is that they are mainly based on platform-based model. Most of them are based on, if like I have to take example of Google, Amazon, most of them are based on platform-based model. So they are trying to earn, or they are earning the residual profit based on, which we can call as platform premium. It is just because of the data that they collect through the platform, or it's just because of the data that they collect from the platform, or the control they have on their data ecosystem, on the data value chain, data ecosystem, or the digital ecosystem. Like the control, their interaction with the local actors or the actors of different jurisdiction is what enables them to have a competitive advantage over their competitors and earn this extra residual profit. So data taxation is another big issue. But so earlier we used to follow a performance matrix of return on investment. of course, now still it is followed, but a question arises that with this much use of data or monetizing the data economy, or it's just because of data, these digital companies are working. So does the performance matrix needs to be changed? So should we make it return on data is equal to return on investment plus platform premium? And this platform premium is the extra residual profit that these companies are earning by their control over the data and the data ecosystem. But surprisingly, none of the proposal on plate today, be it OECD or UN or the unilateral tax measures, take this data limb entirely into picture. They are just trying to find a short-term solution to solve or to get some consensus for the digital economy taxation, but no one is looking into the bigger picture of data taxation or the AI or the emerging or what impact emerging technologies shall entail on digital taxation too, because digital economy cannot work without data. And uh, but I'll not go much into depth of data taxation now. I'll just provide glimpse of the existing measures in plate. Talking about unilateral measures, we see a lot of unilateral measures in play. In different form, in direct tax form, in indirect tax form. So if I talk about EU has been promoting digital service tax, while if I talk about India is moving towards equalization levy or significant economic presence. Not only India, Israel, or some many other countries have tried significant economic presence also concept also. Of course, Professor Alex will discuss this in detail, so I'll not touch base much on this. But the biggest question on this unilateral measures, on this different form of unilateral measures, are is the coverage of this into the tax treaty. So biggest question is whether those are covered in tax treaty. Article 2 of taxes covered in the tax treaty, because those seems to be non-creditable taxes and are extra taxes for the taxpayer. So in a way, taxpayer is ending up paying whole lot of taxes in different countries with no creditable base. Like, let me take the example of India. So in India, the equalization levy is not part of the Income Tax Act. It's not part of the Income Tax Act. So it's completely a separate levy, and hence it's not creditable per se. But of course, there are arguments that it should be creditable, but at present, the taxpayer are not getting credit. Similarly, DST, digital service tax, raises, though it's an easy solution, like the implementation of DST is quite easy in comparison to significant economic presence concept or the other concept, because like in always people have been saying that indirect tax is more easy to levy than the direct tax, because there has been a lot of focus on movement towards destination-based tax flow system. But still, DST also has raised a lot of issues in the EU region on the basis of discriminatory principle. The biggest being US, since US feel that most of their companies are getting captured by this unilateral measures. US has launched investigation 301 investigation, and against France, India, the recent last week, I think, or 10 days before, the report was released against India saying that Indian equalization levy is discriminatory and they are trying to discriminate US companies, and hence they are affecting competition, and hence it's not viable. So on one hand, we have host laws of this unilateral tax measure, even with the entire OECD discussion going on plate. Canada, like in November, came out with their own unilateral measures. It seems to some, like there has been discussion that it seems that none of the countries having faith in OECD, or none of them want to wait till OECD give their taxing right for this years till the OECD arrives at consensus, because nobody knows when there will be consensus. But now I'll jump into the OECD proposal to just give a brief glimpse on the aspects covered in the current proposal. I'll not be covering earlier proposal, just the current debate of Pillar 1 and Pillar 2, wherein they are trying to solve this problem by a two-pillar approach. But Pillar 2 is nothing about digital. It doesn't talk about digital economy at all. In pillar one also, the scope is not limited to digital economy, digital business model. Rather, the scope is covering consumer facing business plus the automated digital service. So pillar one is divided into three amounts. Amount A is more like a residual profit. How the residual profit, the excess profit, which I discussed earlier, like the platform premium or the excess profit which these companies are monetizing, how that should be allocated to the market jurisdiction. So the approach suggested for that is a formula-based approach. EU has long been suggesting triple CTB approach, consolidated tax, corporate tax base, which was again a mechanism of unitary system wherein they say that, okay, take the global profit and then we allocate to different jurisdiction based on some formula covering both demand and the supply side of the market, and then countries agree on some weight. This is how amount A will be allocated, but nobody as of now knows what this formula will be and what weight shall be allocated and where the consensus will be. Hopefully, we will have more clarity today after the public consultation meeting to an extent, I believe. But this is what amount A says. Amount B is trying to retain the existing ALP principle, wherein they say that where they try to allocate the routine profit based on the existing arm's length principle, and amount C, which they have now scrapped out. Earlier it was there in the proposal. Now they call it tax certainty, wherein they are trying to resolve the issues that arise out of amount A and amount B by a set of coordinated measures. Like they don't say a single measure like, okay, we'll go into MAP or we'll go into mediation or arbitration. Like for amount A, they say that it will be 4-step process. In first step, there will be dispute prevention measures. If the taxpayer is not able to achieve a consensus or does not want to go to reviewing panels, then they can go to MAP procedure. If not MAP, then mediation. And ultimately, there is dispute resolution. So even the dispute resolution mechanism that is suggested in Pillar 2 is too complicated. And even to an extent, the blueprint realizes this, and they have highlighted in the blueprint that they will look out for, they recognize that there are various unworked areas which they will try to resolve and make it simpler. But let's see what happens with this. So, but my idea is that to speak here is that we can see that existing, even the OECD is suggesting to move away from the existing ALP principle, and they say and moving towards a combination of method that, okay, for taking into because ALP doesn't take the market side of the economy, like the sales side. So they are also trying to cover the market side based on the formulary apportionment. So there have been discussion, or there are ongoing discussion, that why do we need existing ALP principle if we can stick to formulary apportionment or unitary method standalone? Why not? Which is able to capture both demand and supply side. So in current debate, there is a lot of discussion on ALP, that ALP is no longer viable. It needs to be modified on several grounds. Like ALP is not able to capture the holistic value chain principle also, and now the entities, the activities of the multinationals are so integrated that we need to look into the value chain, entire holistic value chain, for even determining for ALP thing or for carrying out comparability analysis. So I'll leave this topic because Professor Alex will discuss on this in greater detail, that what other alternatives are in discussion for ALP. Like there has been discussion on whether other routes can be taken, like safe harbor, or what other mechanism can be taken. The other question that comes to my mind is that whether it is possible to make a transactional adjustment, like relying more of transactional adjustment in the transfer pricing guideline. Okay, you have ALP, that's fine. There are transactions like intangibles or business restructuring for which there is a transactional adjustment prescribed in the guidelines also. But can we have more of transactional adjustment in the existing transfer pricing guideline to make it more workable? Because there are situations or transaction like in intangible, I cannot find, let's take the example of hard to value intangible, which is prescribed by action 8 to 10 in one action 10. But we don't see perfect comparable for hard to value intangibles. So how do we do it? So we have to make a transactional adjustment, or have to rely on transactional adjustment that either we do on anticipated expected benefit or other transactional adjustment principle, trying to retain ALP in some way by using the existing methods, or say we do ex post situation analysis. But I believe that the ALP doesn't work well in all the current situation wherein we have a lot of data transaction where we need to benchmark data, digital transaction, intangible. So we need modifications or a combination. If ALP is to continue for routine function, then we need a separate mechanism. Whether that should be formulary, okay, OECD is suggesting for digital it should be formulary, but there can be other ways out also, which Professor Alex will discuss in detail, I believe. Then jumping to pillar two solution. Pillar two is nothing about digital tax. In pillar two, they are trying to set up a situation where the entire world is getting some minimum share of taxation. Like every jurisdiction is getting some share of taxes, and nobody is losing out on revenue, and MNEs are not able to exploit jurisdiction for gaining. Like say if UAE doesn't taxes at 5%, it doesn't happen that they pay taxes only at the 5%. They have to meet the minimum threshold that is set under the pillar 2 proposal. Either they pay in residence country or the source country. So the way it is drafted by a set of coordinated rules, wherein one set of rule is more aligned towards resident taxation, the other set of rules is aligned more towards source taxation. So income inclusion rule is one rule wherein they say that if the MNE has not paid sufficient taxes in the source state, the residence country can tax that portion, and in that case also the switchover rule in terms of credit, like exemption method can be switched to credit method. So this is how they are trying to cover the residence limb. Or in the from the source perspective, we have under tax payment rule, switchover rule, wherein they are saying that okay, the source country will not allow deduction if you have not paid minimum taxes, or treaty benefit will be denied in certain situation if the minimum taxation is not paid. This is what they are trying to cover in pillar 2. Though pillar 2 also raises a lot of question because it is still in drafting phase, or I would say that there are a lot of issues. The carve outs are too minimal. Just a small carve out based on fixed asset and payroll is what they are trying to link it. But the biggest challenge for developing countries is that of tax incentives. There is no carve out for tax incentives. Like if I talk about developing countries, let's take the example. Excuse me. Let's take the example of Africa, or say India, wherein we see a lot of tax incentives granted to the companies to promote the FDI of that region. Like in India, we have special economic zone concept, wherein MNEs get benefit if they invest in tax holidays, if they invest in tax holiday reason. But nobody knows the fate of pillar incentive with pillar 2, because if the effective tax rate after incentives is less than the minimum tax rate, companies will have to pay the minimum tax. And in that case, the benefit of incentive might be scrapped out or might not be scrapped out. So the fate of it still needs to be analyzed, how incentives needs to be dealt out with pillar 2, or whether countries should start looking a way out. If there is no carve out, then go towards subsidies, because developing countries do need tax base, and they need to promote foreign investment, and they cannot just leave this situation to uncertainty, and they might have to find some way out for this. Other than this, pillar 2 has raised a lot of questions on action plan 5, that is harmful tax practices, wherein on one hand people are arguing that already BEPS has set up limit for action under plan 5, wherein they have prescribed standards which needs to be passed for saying, okay, this jurisdiction is free, this jurisdiction has passed the preferential tax regime criteria, and now you set up again the limit under Pillar 2. This is contradictory to what Action Plan 5 says. It has, to an extent, some overlap with even the anti-abuse rules, but I'm not going into depth. The biggest question that raises to mind is, in my mind, other than this, is that Action 8 to 10 of the OECD, that is more with dealing with transfer pricing, that aims to align outcomes with value creation. Like they say, okay, delineate the transaction separately and then give fair share to the jurisdiction where value is created, and this is how you do the transaction. But with globe, or this is what Pillar 2 is often referred to as globe proposal, what happens to value creation concept? Because even if a value is not created in a, whether it will be able to align completely with value creation, it is doubtful, because it seems to be little digressed from the value creation principle, and it says, okay, you have to pay align with minimum taxation anyhow. The other question which I have already raised is on ALP, which Professor will take care of. And now I'll jump on to the...
Sorry, Nupur, just sorry to interrupt. We have to take care of time. We are running
Yeah,
behind schedule. Yeah.
just 5 minutes more, 2-3 more minutes. Yeah. Now coming to UN proposal, UN has suggested a simplistic solution. So UN members, when thinking that it is very broad or it is not able to meet their criteria, or to say that to initiate more action from the OECD side, they came up with a less thought proposal of 12B, which provides for a simplistic solution. This is incorporated in Article 12, that is fees for technical service, by a separate section 12B, wherein they are trying to suggest gross basis taxation or a net basis taxation, but it is well thought. It is not well thought, or not much of impact analysis has been carried out on that proposal. But let's see what happens to that. Whether OECD, once OECD is out, the UN will scrap it out, or how does it work? Lastly, I would like to just brief about the tax sovereignty issue that have been on rise because of the bilateral investment treaties also. So we see a lot of bilateral investment treaty cases, the Vodafone case and the Kane case from Indian perspective, that that has raised a lot of question on the confidence of investors on investing in a country, and seeing that, okay, even if government takes some action, they are getting favorable, the ruling goes against the government, and investors are getting favorable judgments at international courts on the basis of fair, equitable treatment, or other action, or other bilateral investment treaty clauses, because of non-specific taxation carve out on in the earlier bilateral investment treaty. But I'm not going much into the depth of this. Lastly, just I would like to mention about a recent case which I read 2 days before, the Coca-Cola case, that dealt with the transfer pricing issue, wherein on one hand we have economic substance rule of UAE, wherein we are saying, okay, EU is following economic substance rule, and now it is not blacklisted from the EU side. And even the GAR, general anti-avoidance rule, says to go on commercial rationality or the economic reality of the transaction. It is this, in this case, the courts have overlooked the economic reality and they focus more on the intercompany agreements. So now, as a taxpayer, I am in dilemma that I need to focus on on intercompany agreements too, and the economic reality too. So MNEs cannot just ignore the documentation part, and to my mind, so both should work together.
Hello, can someone hear me? Hello, Anu, are you there?
Yes, Professor Alexander. I can't hear Nipur actually.
Yes, I think we lost Nepal.
It's okay. Actually, I lost Nipur. So, would you like to start?
Yeah, yes, I'm just gonna go ahead. Can everyone see my screen? I'm gonna see if I can actually make it bigger. Okay, I guess this is the best I can do. Can you see my screen, Anu?
Yes, Professor.
So thank you for the opportunity to actually speak today. Nupo had done a good job giving a lot of the sort of background and just telling us exactly what the developments have been and are still ongoing. What I'll do today again, and also for the benefit of time, is to basically just take us through some of the options that have been considered by some countries, but also some of the options that we could also consider as tax practitioners. Uh, Mind you, most of my conversations will come from an academic perspective, but I believe that they have strong practical implications for those who are interested. So the overriding conversation or question that I try to answer in a very short time is how we should sort of reform international tax rules to effectively tax multinational enterprises. And I've sort of taken the views of countries themselves and of governments, and actually taking the views of developing countries and small countries who are very invested in ensuring that they're able to tax multinational enterprises. But just sort of, just to give a quick overview of the conversation that we're having, and just also some of the things that Nepal itself has actually established, is that revenue from taxing multinational entities for many countries is actually of great relevance, simply because we have many multinational enterprises in these countries who are sort of exploring their natural resources, and you would find data saying that when it comes to tax revenue, most of the corporate tax revenue would come from multinational enterprises in different countries. However, we've come to sort of realize that applying the transfer pricing rules or the arm's length principle hasn't necessarily been all successful, and that has led to the BEPS project. And I guess many of us know what the BEPS project is. So the question becomes that what do we do if we've sort of admitted that the BEPS project itself has in some sense failed? And we have reasons for that. I mean, the transfer pricing guidelines have been deemed to be ambitious, but also they've also been deemed to be complex to sort of measure. As I said, I'm just going to skip through a lot of things, but again, I'm willing to share these slides, and they can be shared with those on the call, and you can read more of the academic conversations that are going on. But just to give a quick summary of why there's been the conversation around moving away from the arm's length principle, and one would have to think of it from two different perspectives. One is the practical problems, but also is the conceptual flaws in the idea of an arm's length principle. From a practical angle, then you sort of have the difficulty in conducting individual facts and circumstances functional analysis and comparable search. And many of us who are practitioners would understand how difficult it is to be able to actually do a comparative analysis for each item of transaction that you have taxpayers doing with related entities. But also is the need for expert knowledge, especially when you look at very niche areas like chemical factories, and even now the digital economy, and sort of understand the background and training of tax authorities and how they are now forced or sort of expected to be able to understand different markets, different sectors, and be able to implement the transfer pricing rules. But also is that there's a large amount of subjectivity that goes into transfer pricing analysis and even documentation. But also away from a practical difficulty, we also have sort of basic conceptual flaws. The separate entity concept illusory, and we've come to realize that the whole is always more than the sum of the different parts. And that for many multinational enterprises, they make profits from synergy as against profits. More profits are made from synergy as against more profits from them acting as individual entities. But also is that in a multinational entity, you'd find out that you have key functions being centralized: finance, R&D, risk, and because of the centralization of these key functions, now trying to or attempting to apply the arm's length principle becomes really difficult and sort of unsuccessful. So due to the problems of the transfer pricing rules, we now sort of led to the BEPS project and beyond in terms of what we have today. And let's always remember that the overall goal of the BEPS project is simply to sort of align profits and tax with real economic activities. And the question becomes how much of success has been observed from the OECD trying to do that particular task. And one could actually claim that that task is ambitious. Well, we've seen some achievements. I mean, the country by country reporting, CBCR, the master file, the local file. We've also seen, again, from a practitioner angle, we've seen more relevance being given to the profit split method, even though, again, there is still a lot of insistence on the transactional analysis that you find under the arm's length principle implementation. However, in 2019, for many of us who sort of are historians of the OECD process, we found for the first time a sort of a commitment by the OECD to move away from its stubborn hold on the arm's length principle and transfer pricing rules. And in January 2019, in its OECD policy note, you can refer back to this note, it for the first time admitted that it was willing to look for solutions that go beyond the arm's length principle. Now, what we've seen since that statement has been many evolving solutions being explored by the OECD. As Nupo mentioned, now we have the OECD actually considering formulary apportionment. And if you went back to the TPG of 2017 and the TPG of 1995, you'd read the OECD completely condemning the potential formulary apportionment as an option. Again, I'll come back to this as we move forward. But there are many issues that we have to think about when we're looking at this particular issue. The digital economy has brought more into the conversation. That has become more difficult for us to actually say what exactly it is that we need as a solution. Paul has mentioned some of the difficulties of trying to determine an amount A, an amount B, amount C, and how those would be implemented. Again, I won't focus on that. But we've seen how digital economy has become a very difficult sector to find a solution for. And because of that failure, we now see countries actually finding different means of sort of addressing the issues. One that we found is countries trying to adopt a wider definition of permanent establishment. For example, now we have significant economic presence becoming one aspect of being able to effectively tax multinational enterprises by actually redefining permanent establishment to now make room for a digital economy. For example, a country like Nigeria in 2019 in its Finance Act, granted more taxing powers to jurisdiction where you're able to establish economic presence in monetary terms and being able to say this is the monetary threshold that you would need to have. And I think it was around $5 million to be able to now become present in that particular jurisdiction for tax purposes. But we're also seeing efforts around global minimum tax and what that has meant. And as Nupo mentioned, we've also seen very unilateral measures being taken by countries. But so that's also a basic background. But now I'm just going to look at, there are 4 different options that I'm going to discuss today quickly. Again, I might just have to skip through the slide, but I said I will share the slides and then we can refer to them. One is digital service tax. The other is alternative corporate minimum tax. And we also have formulary apportionment, which again, many of us know about. But finally, we have the issue of safe harbor regimes. So digital service tax has become one of the turning or interesting issues that we have today, almost leading to trade wars. I mean, we know what the conversation around France and the US, and the US threatening to sort of impose more tariff on French products if France goes ahead to introduce the digital service tax. But we've also seen some other countries, for example, Kenya, which would be the case that I will use in explaining the DST, at towards the end of last year, enacted an income tax digital service tax regulations 2020, which came in force just less than 2 weeks ago. But the important thing to bring out from this particular regulation will be the definitions of different aspects of it that sort of tells you how countries are thinking about digital economy. Number one is when it defines platform, it looks at platforms as any electronic application that allows digital service providers to be connected to users, of the services directly or indirectly, and includes the website and mobile application. So again, so that sort of tells you the sort of the reach that the country is aiming at. But also digital services include over-the-top services, downloadable digital content, provision of digital market space, sale or licensing, or any other form of monetizing data collected about users. So for different applications that sell data, maybe in case in point would be WhatsApp and the likes, their activities would be caught under the DST. But the DST applies both to both residents and non-residents that sort of derive income or from Kenya, or if the income accrues in Kenya. Now, we've seen that a lot of times from an academic perspective, many countries sort of either define your liability to tax there on sort of income derived, brought in, received in, or accrues in that particular country. And we've seen how, for instance, for non-resident, it's difficult to sort of tax them on income received in that country since they do not live there. So the DST of Kenya actually looks into that particular dynamics in saying that whatever income that is derived from or accrues in Kenya will be subject to the DST. But also is that to prevent double taxation, there's an offset regime that for residents or non-residents with PEs in Kenya, at the end of the financial year, there'll be opportunity to actually offset the DST that you've paid against against your income for that particular year. Where there's no PE, then that DST becomes the final tax, just as we all know with WHT. But also the DST is paid on the gross transaction value of the digital service, which is also sort of an interesting conversation, because many people have been asking, on what will you impose the DST? Will it be on gross value or net profit? And then the difficulty of trying to think about the net profit. And finally, the rate of DST is 1.5%. That's looking at DST sort of, takes us smoothly into the next conversation, which looks at alternative corporate minimum taxes, right? And I give credit to my colleague at ICTD, Michael Durst, who has spent a lot of years trying to work on this particular issue. When you think about alternative corporate minimum tax, just like the DST, it's simply you imposing a small percentage on the total revenue or gross revenue of a company, rather than imposing what you call a nominal tax rate of around 30% on the taxable profit of that particular company. And there are many countries actually that actually adopt the ACMT either as sort of an alternative, or actually the main tax process that you find in that particular country. And here again in the slide, I have a simple calculation for those who are interested in sort of understanding the math behind adopting this particular system of taxation. I mean, there are arguments against an alternative corporate minimum tax. One is that simply because you're taxing the gross revenue of a company, there are instances where you where you make a company pay taxes, even if that company at the end of the its calculation hasn't made profit. And we know that taxes are on profits and not necessarily on revenue. However, given the need to sort of address BEPS, then the argument becomes if imposing that minimum tax on the gross revenue for countries now who want to actually collect tax revenue wouldn't be a better option than the argument that you might be taxing companies even though they've not made profits for that particular year. But I said the potential advantages of the alternative corporate minimum tax, because you're not looking at deductible expenses and allowances. The room for manipulating the numbers is not there. Now, one could argue that, well, you can manipulate the price of the item, but that also is something that is applicable under the ALP or whatever other form of taxation that you adopt. But at least because you're not looking at the gross turnover of that particular company, you're not focused a lot on whatever expenses or deductible allowances that they've claimed, but just focusing on what they've done, which sort of largely reduces BEPS erosion and profit shifting. The other one that Nupol kept mentioning is Unitary Approach and Formulary Apportionment. I'm going to again skip a lot of slides there, but I think many of us understand what the Unitary Approach is really. It's simply that you start treating M&Es as one single business, and then you tax them on the global profit. Now, we've seen many arguments. As I said, the OECD at some point said that applying the Unitary Approach will move away from the Amsterdam Principle and abandon the sound theoretical basis on which the Amsterdam Principle is founded, that it threatens the international consensus, thereby substantially increasing the risk of double taxation, or that it will be difficult to get a consensus on the predetermined formula and composition of the group. But as I mentioned, we've seen that some of the fears of the OECD are no longer present, and there is now more openness towards accommodating the arm's length principle. But for you can actually apply the the unitary approach, and before you can apply this, you would have to define what becomes a unitary business and what parts of the business are included for unitary taxation purposes. Also, you have to think about the formula, and in the formula, you're thinking about what should be the factors you're going to use and how you're going to weigh those factors. And just to sort of quickly say some of the things you find in the literature when it comes to this. In determining what a unitary business is, the US court has decided in the case of Butler Brothers that a unitary business is present where there is unity of ownership and unity of operations, and in some instances, all unity of operations. So that in this particular instance, the moment you can find that there's a legal relationship or there's an economic relationship between the entities, a significant economic relationship, then you can actually say that particular, those companies have a unitary business or be considered as a single firm, and as such should be treated in that sense. Then you go to the other half of it, which is formulary apportionment. How do you apply the formula? What factors do you consider? We could either use the Canadian system, which basically applies a two-factor formula, or we focus on the Massachusetts formula, which basically applies a three-factor formula, weighing each of them equally. Again, as I said, I would leave this to anyone who wants to discuss, wants to look at this further. But what I've also done quickly is to create scenarios in the slides of what a country would earn if it earned tax revenue from a company using the arm's length principle, and what it would earn if it did using the formulary apportionment. Then finally and quickly, we're looking at safe harbors, and I think departing away from how safe harbors have been described under the OECD, the intention is to start thinking about safe harbors as administrative simplification regimes for a category of taxpayers or transactions, and then sort of start asking ourselves, which do we choose between accuracy or simplicity? And looking at it from the angle of simplification, that we don't necessarily restrict ourselves to what has been put in the TBGs or what the OECD has said a safe harbor is. But then what we do is to take a group of taxpayers, either an oil and gas company or manufacturing sector, and then we try to find a system that would work for that group of taxpayers. So we do not think about a one-size-fits-all approach towards taxing these people. We actually start applying tax regimes that would apply for each sector or each group of taxpayers, or for even each transaction. So it might not necessarily be the group of taxpayers, it might be for each transaction. A good way to think about it is when you think about the advanced pricing arrangement, the APAs that we have, and then now taking APAs from being an individual to a group think, to say, okay, if APAs were always negotiated with individuals, can we now start negotiating those APAs with a group of taxpayers or taxpayers involved in similar transactions, and then having such simplification tax regimes for them? If you think about it that way, then it means that either a formulary apportionment or a DST or alternative corporate minimum tax or whatever system that we think works for that particular group of taxpayers or transactions becomes the applicable one, and not necessarily trying to restrict ourselves towards what the arm's length principle or transfer pricing rules say on safe harbor regimes. So again, I've included the concerns with adopting the safe harbor regimes in the conversation, types of safe harbors, substantive safe harbors, design of safe harbors. And for the sake of time, I'm going to stop here. I'll share the slides, but also give at least 5 minutes for us to ask questions on some of the things that I've quickly rushed through. Thank you.
Thanks, Professor Alexander, and thanks, Nupur. We are ready to take questions now from our viewers. So first question that I have received here is for you, Professor Alexander. The question says, can the OECD prescribed methods work in the post-COVID economy? What alternate methodologies can be adopted to supplement the arm's length principle?
So again, I've just gone through some of the methods that would, and I think that we can all agree that that post-COVID, the arm's length principle or transfer pricing rules would not be acceptable by countries, simply because countries now understanding the BEPS aspect of it will be very much determined to block all loopholes that are currently present. And so what you'd expect is that countries would sort of depart, and that's why again you realize that it's difficult right at the moment to find a global solution, because countries are coming with more bargaining demands. And what are the options? I mean, some of the options that I've mentioned, some of them offer you simplification. For example, a DST on gross payments or gross revenue of a digital economy has very few of the limitations that you have trying to get what the taxable profit should be. Similarly, for an alternative corporate minimum tax, which basically just focuses on the gross turnover as against the taxable profit. But eventually, I think if you're looking for a very fair system, then we need to focus more on the formulary apportionment, simply because then you're looking at time where tax is paid with where the economic activities occur themselves. And I think that becomes the long-term goal for the global community. But for individual countries, the matter of looking at some of these options and asking yourself which of them should be a quick fix for your tax system.
We have a question for you here. The question says, do you believe that a global consensus on OECD, BEPS Pillar 1 and Pillar 2 can be achieved soon enough to empower countries towards a transparent tax regime?
I think the answer to this is very dicey. They have been saying that, okay, this year they will try to achieve consensus. And I believe to an extent that much of the effort have been put by inclusive framework members also. They have been very active with the participation, submissions. So there will be some solution, but on which everybody will agree to it. But it is difficult to comment that whether the developing country or the members of inclusive framework, much of whom many members are developing country members, they will actually end up gaining anything, because even the impact analysis shows that Pillar 1 is not going to give much to the market jurisdiction. It's more like, okay, we are part of inclusive framework, we are trying to agree on the solution, without knowing that in the end, the developing country may not get much out of it. But there will be some or the other solutions, consensus to my mind, because a lot of time and effort have been put by inclusive members also. So I believe, I'm not sure on the timelines, but there should be some solution. Professor Alex, what do you have to say on this? Do you
one is, again, I think we'll find a lot of countries trying to hold on to the fiscal sovereignty. And I think countries are more awakened to the gimmicks of the global north, especially the global south countries. And many other countries are looking for quick fixes, especially as an economic recovery from COVID. So it's difficult to say what anyone will be. I mean, we've seen the OECD really struggling with getting that global consensus, and I doubt that anything would happen in the first quarter. But again, you never know. So let's keep observing.
So next question, Mr. Gopala Ravi, would you like to ask the question?
Sorry? Yeah. Can you hear me, please?
Oh, yes. Yeah.
Okay, good. Thank you. It was very interesting, Nupur and Professor. I have just one simple question for companies operating in the UAE. I'm referring to not the multinational companies, the other companies which are operating here. There is an ESR regulation which is already in force, which we are aware. But other than that, are there any specific laws which are already promulgated relating to, say, transfer pricing, BEPS, etc., which are in force today? That's my question.
So what I believe is that transfer pricing documentation is in place and the ESR rule are in place and VAT regime. But to an extent, since this countries are part of inclusive framework, we will see more of minimum standards coming into play in coming times.
Yeah, but as Professor of today, there is no specific law. This is my understanding.
I believe so. Professor Alex, you have to add anything?
For the UAE, I wouldn't be able to speak because I have not looked at their tax laws. But I know that, for example, for Qatar, depending again on where you operate, either you operate in the financial center or the free zone, there would be different tax regimes for different sort of zones that you operate in. So, for example, here in Qatar, there's a corporate income tax of 10%, but also which, again, depending on your ownership structure, would sort of influence what liability would be. And that's for Qatar. And also if you operated under the QFC law, then there's a different tax liability also. If you put it under the QSTP law, there's different tax liability. So I think for the UAE, I won't be able to speak, but for Qatar, the tax laws you have to look at the specific tax regime that you fall under for that.
Thank you. Thank you.
Thank you.
Wellington. Ms. Wellington, would you like to ask the question?
Yeah, hi. I would like to ask about, again, the transfer pricing. So I believe Professor Alex can help on this. So we know that in the multinational companies, the transfer pricing adjustments is another crucial matter, but there is a difficulty with the custom authorities. So how the custom authorities approach for the transfer pricing adjustments? Because the transfer pricing adjustments is just handling by the tax authority, but there is another authority which is custom. So there may be kind of like disputes. So in this manner, what he can tell us, and one another thing regarding with the advanced price agreements, which is in line with the transfer pricing, is the APA agreements, advanced price agreements, are really protecting to any TP exposure? And in other than Europe, is there any country is effectively using this mechanism?
No, thanks for the question. And this debate around customs assessment and tax authority assessment have always been an issue. Now, for countries where both the customs and the tax authority are merged, then you find out that whatever you get from customs as a TP assessment can be used for every other thing. However, for countries where you have separate agencies, then you find out that most taxpayers would not argue with the customs much because they want the product or the service out or imported or exported, but then they would argue more with the tax authority because now they've made profit and it becomes different. Now, what you realize is that customs, knowing that taxpayers are eager to get their goods in or out, would sort of inflate or whatever, or just insist that you pay whatever rate it is. So you find that many a times, if you take whatever assessment from customs and you take that assessment to the tax authority, you would hardly get the same. Either you're trying to renegotiate if they've given you a higher bill, or you're trying to get a lower one. So different countries deal with this, and it's a good example is in Kenya. In Kenya, customs and tax are united. However, in Uganda, they are separate. And so understanding how that separation works has always been the headache of taxpayers. That's one. Secondly, on APAs, yes, there are countries who use APAs, and many even within the continent. I think Uganda introduced APAs, and some other countries have used, Zambia also have used APAs. And whether they're effective, I mean, the problem more about APAs is not whether they're effective, is whether they lead to corruption. So what you find is there's something called corporate capture. So you see this also in the Luxembourg leaks in Luxembourg, and now that led to the Lux leaks. And but if you take away the view of corruption and whether they're effective, yes, because then they grant the taxpayer certainty that this is what the tax authority would accept, and also they grant the government certainty that this is the revenue that will come to them. So if I have APAs with 100 companies, then as a government, you can forecast that, well, I've agreed with these guys, this will be what will be used, and this is exactly what I can expect. And that's why I said that for a way to look at safe harbors is to not think of APAs from a group perspective, to say if we have a group, think of APAs, where rather than I am agreeing with an individual, you agree with a group of taxpayers, then there's more fairness, and then there's little room for corporate capture or little room for corruption. So that's one way to think about it. But APAs as standalone tax policies are actually really effective, and I would say that many countries, actually use them for many purposes.
I'd like to add, so India has a very good APA system. So it is appreciated by many countries that in recent time, they have been able to resolve many issues, and the team is very good, and they are cooperating with taxpayer, and we see a lot of unilateral APAs from the Indian side. So it's working very well for India. And regarding the adjustment, even if the authorities are different, many countries have started, they realize, the tax authority realized the problem of valuation between custom and transfer pricing. So many countries have, issued separate guidelines for this in the transfer pricing, or some sort of guidance that, okay, if there is variation in valuation, you will deal with this matter in this way. That is what I would like to say.
Next, we have Jana Balutik. Would you like to ask a question now?
Yes, thank you for the opportunity. And first of all, thank you to both speakers. It's been very insightful. And I'm just from a kind of very far away in terms of the taxation, but working in a multinational and based in EU. Sorry, in Switzerland, but with a lot of operations within EU. My question is, how long do you think it would take before the changes and moving away from the arm's length principle become indeed effective? And the reason for asking is I would expect a lot of resistance from different parties.
Yeah, I would agree. And if Pillar 1 goes through, then still we can say that we see little hope, and we can see in coming time unitary system, not now, in coming years. But it's difficult to say that if Pillar 1 goes through, at least people will have argument that OECD has started accepting this and countries have also accepted. Then I see more of a scope from consolidated tax-based perspective or unitary perspective in coming years. Professor Alex, if you want to add anything.
I wouldn't worry as an in-house counsel. I wouldn't worry that this would happen in the next 4 years, because even if they go through, they'll have to put an implementation date to get people now being trained on the new system and get the new system to become effective. And so, I mean, you could probably see post 2025, but again, I wouldn't even get my hopes high.
Okay, thank you.
Thank you too.
Do we have more questions, anyone?
It's good. I have to run because I have to teach a class soon. So
yeah. So Professor Alexander and Nupur, thank you so much for these insights. It was a very, very insightful session. Thank you everyone for joining in, and thank you so much again.
Thank you.
Thank you.
Bye.